Okay, we're going to do chapter 5, which is all about inventory. So chapter 4, we were introduced to a merchandise company. They're selling merchandise, some sort of goods. And we're going to just take that and kind of focus in on the inventory piece. So what is inventory? So Larry, you work in supply, right? You bring in equipment for departments that need certain things. You work at Oshner, right? And you're in supply. So when he goes into let's say he goes into a hospital and they're setting up a floor and they need certain equipment. So all of these products is their inventory. Everything that the hospital has, from hospital beds to tubing to oxygen tanks to PPE, whatever it is, right? That's all of their inventory. And so there are people that are going to be in positions that are going to be looking at those inventories, and they're going to be looking to see, you know, where are we in the inventory? What needs to be ordered? Something that simple, and they're going to be purchasing. You're also going to have people that are analyzing what type of inventory is being used, what's moving through, right, that we're using a lot of, and how do we keep up with that? How are we costing these inventories? So remember, we learned about cost of goods sold. So this inventory, like when we're selling these pieces out, patient comes in, they're using this stuff. And so we're billing that to those patients in a hospital. And we have to know how we're going to cost that. Maybe there's a bunch of a little bitty thing, maybe the little tubings that they use to come in when they take your blood. And they have different quantities that they buy at different costs. Sometimes you get, you know, a really great deal. Maybe they have a special on something. They've gotten a lot of pieces for a certain price. And maybe you have another batch that's a little bit higher in price. Well, we're just going to average that out, or do we want to know how we're going to keep track of those? Is it going to be different types of methods that you have to identify, okay, this is the cost that belongs with that inventory that we're charging out? Okay, so that is for all industries. And we'll get into a little bit of those different methods, and I'll talk about some different industries and how they do that. So that's what inventory is. Inventory is just your goods that the business, the company is going to be using, right? That they're going to be using and selling. They have them, they're holding them, they're available, and they're ready to go for you to sell. That's how we make our money. We have parts that go along with our services sometimes. So we have inventory. And then we talked about the goods in transit. Talked about FOB shipping point and FOB destination. Sometimes when we have these inventories that we order, we have a cost of those inventories that shows up on our invoice, but we also have additional costs sometimes. Sometimes we maybe have to pay someone to put pieces together to get the inventory ready for me to sell it. That could be considered a cost that gets added in. Maybe it's the shipping, and I have to put that on there. It could be just labeling of some sort. So there's other costs that could get added to your inventory. So the FOB destination, remember that the cost for freight is only costed to the buyer if it's FOB shipping point, because it's transferring ownership at the shipping point. So once I ship it, I'm the company that's shipping it out. It's no longer my inventory. I don't pay for the cost. So if I'm buying, as soon as it leaves the shipping point, then it becomes my inventory, and I'm responsible for the cost of that. And I'm responsible for the insurances to get that inventory here. So all of those costs can be added. So remember destination and remember shipping point, because you're going to have to know if you're given a problem and it says, okay, here's how much it costs for this, and here's what the insurance was, here's what the shipping was, it was shipped after FOB destination. You know, okay, that's destination. As soon as it gets to the destination, then I own it. So it hasn't arrived yet. It's not my inventory. I don't have to count it. And I also don't have to put that shipping cost into it when I receive it, because it's destination. It's when it gets to the destination point. Okay, so remember those two. Okay, so the inventory costs, we just talked about that. Shipping, insurance, storage. I didn't mention discounts. Sometimes when we buy inventory, we just went through this in chapter 4, we may have an opportunity to take a discount on that inventory. Many reasons. It could be because the vendors offered us the opportunity to pay within a certain amount of time and we can get a discount. So that 2/10, 2% 10, if I pay it in 10 days, I get that 2% discount. That will decrease my cost. So different companies keep track of it different ways. One is to reduce that inventory. Sometimes you can keep it in a separate account if you want to track that, but it reduces my cost regardless of where it sits. So I have that. And I also have another way that I can get a discount is maybe I have some inventory that came in and it's slightly damaged, but I can still resell it. And I ask for a discount on that and I get it. So you have discounts, so you'll just take those out. Okay, the expense recognition principle, this was on the test. And I said that, you want to recognize your expenses as they're incurred. So the way that we want to talk about this with the cost of goods is when the cost is expensed as the cost of good, it's sold in that period when the inventory is being used and sold. Okay, so we're recognizing the expense, that cost of goods, when we're selling it. So if I have sales of these projectors in February, I want to make sure my cost of those hits February. I don't want to put it in March. Okay, so what kind of inventory controls do you think that you have? So when you have inventory, so let's talk about an audiovisual company. They're going to have all kind of electronics. They're going to have all kind of cables, projectors, screens. They'll have cameras. They'll have computer laptops. They'll have all kind of stuff, TVs or big monitors to go on the wall. There's all kind of inventory. So wouldn't you think you want to protect that inventory, right? You wouldn't want to just leave it open for anybody to walk in, right? Anybody can walk out with it if there's no controls. So you have to have internal controls. And some departments, it's more, it can be a bigger loss than other departments. You have casinos that have, cash coming in all the time, right? So you have to have internal control. So all your departments are going to have some sort of internal control. But for inventory, when you have that internal control, you need people that are making sure that this inventory is labeled properly, is received properly, that they're checking the cost of that equipment to make sure that what the purchasing agent said that cost should be, someone's receiving in that equipment and they're checking that, maybe that purchase order to see how much were we supposed to be paying for that? Is that on here? What is it? Does it match? And so that you may have somebody doing that with the internal control. You may have someone that is responsible for putting physical controls in place so that people can't come into that department. So I'm sure when you go to, let's use the hospital again, you're in the hospital and you want to go buy your, your prescription. You can't just walk through the aisles in the back by the pharmacist, right? You have to stand behind the counter and they'll get it for you. They're controlling their inventory of that product so that you can't just come in and get the inventory. AB company, we did the same thing. We just had a physical gate. They had a space that the guys could come stand in to load up the vans in the morning. And we had inventory people that were taking care of going to take that inventory and pulling it off the shelves and bringing it out to them. They were not allowed in to go, roam around and just free for all. So you have internal controls. You're also going to want to do physical counts. So this happens at least once a year normally at most companies, but you may have that more often. It may be quarterly, could be monthly, that you're doing physical inventories. And with the internal control piece, you want to make sure that who's doing the inventory count isn't the person that's in control of the inventory. You have other workers that come in. Some people have third party that they hire to come in and they'll walk through and do the inventory. So they'll do a count, they'll use little tickets, go through, maybe we used to use colorful dots. And so we would know this is our color for this count. And we put, certain dots on these different pieces or boxes or bins if we had little small pieces. And so you have controls over who's counting, how you're labeling it, you're coming back with a physical count, and why are we doing that? We want to make sure that the reports we're printing out of the accounting software, they're going to give you a quantity. of how many pieces the accounting software is saying you should have. So you'll have a report, and then the count comes in, and management usually will take that and compare to see, do I have what the computer's saying that I have? And there's a lot of different reasons why there could be a variance. Hopefully it's not because somebody just stole a TV and walked out, right? Although we've had that happen. So it does happen, even though you try to have controls, but you hope that it doesn't. And you try to limit that with your controls that you put in place. So your internal controls are really important. Physical counts of inventory is really important. How does that affect your financial statements? So if I have pieces that are missing, what happens? What do I have to do? I have to remove them off of the inventory list. They're no longer an asset because I don't have them any longer. So I have to remove them. Well, what happens? What's the other side of that? So if I have an asset that normally has a debit balance and I have to remove it because it's gone, I have to credit it. So I know what my credit side is. What would be my debit side? An expense, cost, could be loss, account. You could have go right back to inventory. It's getting added back to inventory to increase. To cost it back out, cost of goods sold. So it could be cost of goods sold where you're hitting your income statement to reduce your sales. It could be an expense account where it's in the bottom line, it's hitting your net income. Okay, so we have two systems of costing. And we talked a little bit about this when I mentioned inventory before. There's periodic and there's perpetual, and you're going to learn both ways to do the tracking of the parts, different methods. There's two systems and there's multiple methods. You're going to learn all of them. And so the reason why is because one's easier than the other. Periodic is periodic. You will go and decide, okay, at the end of this period of time, I want to do an inventory count and I want to look to see what my cost is going to be on these particular products. You go through your sales, here's my sales, here's my count for my sales, and I know what went out the door, and I'm going to take that number and just say, okay, this is what it's going to be at the end of that period. So it doesn't matter if in the beginning of the month I sold 5 and then I purchased some more in, maybe I purchased 10 and then I sold 2 more, and then I purchased 3 more, then I sold 5 more. All that activity is happening through the period. Let's say it's a month. All of that in and out is happening, but for periodic, it doesn't matter. You just want to know in the end, how many did you sell? So you can come up with your cost of goods sold. So it's just taking that period of time. Perpetual is a little bit different. Perpetual, you're doing it as you go. So every time you buy, it changes where you're pulling your inventory from, depending on the method that you're using. Okay, but you go in, okay, I sold here, so what's my cost? I need to calculate it at this point in time. Then maybe you buy some more and then you sell again. Well, now I got to recalculate and see where did the inventory come from and what is my cost on it. So now I buy some more, selling again, I got to figure my cost out again. So you see how that goes? It's in and out. You're keeping track each time. That's perpetual. The 4 methods that we're going to walk through tonight, we're going to do some of the homework problems because I have both methods and all 4 methods in both systems, both periodic and perpetual in the homework. So we're going to walk through some examples doing that homework so you can understand how to do them. Okay, first, FIFO. FIFO is first in, first out. So I have inventory coming in, let's say it's June. So I have some inventory from May that's now in June. And I have a purchase that I make in the beginning of June. So now I have some inventory that was already there. It's a balance that comes in, a product that was already on my shelf. And then I purchased some more. What first in, first out is saying that when I sell, I need to look to see what came in first. So all my stuff from maybe that, purchase that was in May, that needs to go out first. Then my purchases from June go out. So that's the first in, first out. Then we have LIFO. LIFO is last in, first out. So think about it in reverse. So now I have some inventory that's on my shelf coming into June, and I just bought some more inventory. When I have a sale, what's going to go out is the last thing I bought. So whatever I bought in the beginning of June, that's what's going to go out. I have weighted average. So now I'm just taking the average of what I have. Depending if you're using perpetual or periodic is when you calculate that average. If it's periodic, you're looking at the end of time and you say, okay, here's all my costs that I paid for this stuff, and here's my average of what I sold. That's my cost. Or if you're doing perpetual, you're doing the same thing. Each time you sell, you're doing that new average. And then we have specific identification. So specific is obvious. It's specific to that inventory. And there are times that you would use this. So think about a car dealership. You wouldn't average out the cars. The car dealership, it's a bigger piece, has different packages in it. Every car is a little bit different. And so that particular car is going to have its own, it's a stock number is what they usually call it in the car dealership world. So you have a stock number on the car, and all of your costs associated with that stock number goes to that car specifically, right? So maybe I did a tint on the windows. Maybe I put a pinstripe on the side. What are some other popular things you do to a car? No, maybe I got a kit on a truck that's got the things on the bottom, what they call where you step up on. I don't know what it's called. You're able to step up. So let's say I put that kit on my truck. Well, all of those costs are going to get added to the vehicle. So when I go to sell that vehicle, I need to make sure all of those costs are specific to that truck. And then when it goes out, all of those costs are included in my cost of goods, right? So I know what to sell it for because all of those costs are on it. That's when we would use specific. So in the class, we'll just use it with the same thing. We'll just have some pieces that they have, and they'll identify which ones, how many quantities, and what was the cost of those quantities, right? So you wouldn't maybe want to keep track of that. Like, let's say you have some clamps that go out and tie off these cables to make things neat. And you have an audiovisual company, and you have all these little clamps, and you have all these little cables that you use. You wouldn't want to keep track of that specific, right? You're using a lot of that stuff. And so that wouldn't be a good, reason to use specific, right? You wouldn't do that. You probably average something like that out. Now, if you have a projector, that's a big projector. Maybe you have, a fancy classroom and they're buying $20,000 projectors. That particular piece may have its own stock number, right? It's going to have its own serial number, and it's going to have its own cost. And just a little tidbit, a lot of times when you're selling to education or government, they get special pricing. So what happens is their pricing on these inventory pieces are going to be lower than what someone that's in a commercial setting would pay for it, right? So in that sense, maybe a larger piece like a projector would have a stock number or a serial number that's linked to it some sort of way. And it's the specific cost that's going to go on that. So you would use it for a smaller piece. Doesn't have to be something as big as a car. There's other times that you'd want to use that. So do you have any questions about inventory so far? Okay.
So specific identification is for something that's like a lot of value.
Usually.
And then weighted average is for something that you can usually buy in bulk.
Yeah.
And then I don't understand.
The LIFO and FIFO?
Yeah.
So LIFO, FIFO is probably a lot of like the same, like smaller pieces, smaller inventory pieces. Maybe you have bulk of it too, but you'll have these lots that are coming in and they're identified by their price. So there's software that will keep track of that kind of stuff. And, you'll have different pieces that have different costs on them, and somehow the system can track that. So then when you go to say, okay, I'm using LIFO, I'm using FIFO, it knows where it's pulling from. And it's always pulling that oldest inventory, and it's going to have the cost of that old inventory. So you got to think about too, how do you want the ends to be on your financial statements when you use different types of inventory methods? Because remember, you're using different methods, cost is going to be slightly different. So you have to decide, not outside of specific, how do I want to cost this? Because I want to know what's my impact going to be on my financial statement. Do I want to show higher costs going out and I have a lower income, or do I want to show lower costs of my cost of goods and have a higher income? Because that's going to impact what the financial statement looks like. So some of the homework will have that piece on there too. So you can see how's it changing what my income statement looks like, depending on what method I'm using. So I have a note on here, first in, first out. It doesn't matter what system you're using, periodic or perpetual. So whichever one you like, you can use for FIFO, because the answer is going to be the same for the cost of goods. So you don't have to know how to do both ways for that particular one, whatever it is, for periodic, perpetual. If it says that it's FIFO, you can just do whichever one you want. It will have the same answer. And then the same thing for specific, obviously, because you're using specific. Okay, so financial statements, how it affects the cost on there. So if we have a rising cost, so maybe we're buying pieces that we know each time we buy, it went up a little bit. That's what the rising cost is. Every time I buy it, it's going up slightly. So if I'm using FIFO, first in, first out, what I bought last month is obviously going to be a little bit lower than what I'm currently buying it at, right? So when I put that onto my cost, I have a lower cost of goods sold, which means I have higher gross profit. Does that make sense? So if I have first in, first out, cost is rising, that means the older pieces have a lower cost of goods. And then flip that for last in, first out. If the rising cost, so I have a higher cost of the new stuff that just came in. So what's happening to my income statement? I'm having higher costs that now are going out, and I'm going to have lower gross profit. And then the weighted average falls somewhere between the two. Falling cost is the opposite. So if what I'm purchasing over time is decreasing in price. So when I decide to use first in, first out, now it's not lower, right? Because it's going down, so that's gonna be the higher. And so now I have a higher cost of goods and a lower profit. Last in, first out, it's same thing. The last ones coming in are lower in price. So if they're lower in price, that means my cost is lower. That's going to the income statement. So if a lower cost of goods sold, if I have a lower cost of goods sold, that means I have a higher profit. All right, then we have something called lower cost to market. I don't do a whole lot with this. These problems are pretty easy. So you have something that's, you want to evaluate what costs you have of your inventory. So we can go back to the electronics at an audiovisual company. So think about electronics, they're constantly changing. Projectors are constantly changing, right? Technology is always better. They're smaller, they're cheaper, right? So the older stuff is a little bit bulky, a little bit higher in price. The new stuff maybe is better. So what happens to that old product? So now I have some old pieces that I didn't sell. They can become obsolete even, but they may have a higher cost than what I can sell it in the market, right? So sometimes the market price may be lower than what I paid for that inventory. That happens. And so you have to be real careful when you work in inventory to make sure you don't have those types of products that are just sitting on the shelf. You don't want a lot of that happening because you could lose a lot of money. What happens if something like that happens? So we're going to look at lower cost to market because of that. So what happens is the market is in terms to what is it going to be to replace that. And if it's lower in the market, then I want to make sure that I reduce that cost that's sitting on my balance sheet. My inventory is showing a particular cost, could be overstated because the market, the lower price is where I need to be. So you'll make an adjustment. If the value of the piece, the market value is higher, than the inventory, then I'm not going to make an adjustment. I only want to adjust if the market price is lower than what I have on my books as my inventory costs. Okay. All right, here are some formulas. So these are just real simple little equations to memorize, because you'll have these in the homework. These probably pop up on the test. So we have inventory turnover. Measures the number of times the company's average was sold during an accounting period. And then we have, is the management doing a good job controlling that inventory, right? You don't want too much inventory. We just talked about why, because sometimes it becomes obsolete and you can't sell it. And then you're just sitting with this inventory that you can't do anything with. You can't make money that way. So we have to see, are they doing a good job? We may have to use this formula to check that out. There's a lot of different ways to analyze the data. So we have a low ratio. The company may have more inventory than it needs. We have a very high ratio. That might mean that our inventory is moving too slow, right? It's too low and we can't cover the sales. So we'll lose them because we can't get the products. And then we have a high ratio, which is where you want to be. That's adequate. That's, you want to be somewhere, you don't want to be too high and you don't want to be too low. Okay, you want to be just a high ratio is good. So we have the inventory turnover. We have cost of goods sold divided by the average inventory. And that's the formula to come up with the average inventory. So we're going to take the beginning inventory plus the inventory and divide it by 2. So we talked about how to figure out the beginning inventory and the ending inventory. We know from the formula that we had for the last test, beginning inventory, right, plus that purchases gives me what's available. So that's everything that I have available that I can sell. Then I sell some of that. So now I deduct my cost of goods sold and I come up with my ending inventory, what I have left on my shelf. So I want to take that beginning number and that ending number, add them together, divide by 2, and that gives me an average. Okay. So cost of goods sold divided by the average. Then we have days sales and inventory. So we want to measure the adequacy of the inventory to meet the sales demands. It can be viewed as a measure of the buffer against the out of stock inventory and useful in evaluating how quickly inventory can be sold. So we have the days in sales inventory formula, which is ending inventory divided by the cost of goods sold times 365. So just remember those formulas so you can plug your numbers in. It's always times 365. Okay, so you're ready to work through all these different methods? Could be a little tedious when you do perpetual. So make sure you have, give yourself enough time to do the homework when you're working through them, because it can be a little bit time consuming. I don't know if I can. I don't know which side I like that on. To see when Connect opens. Do you have any questions on Zoom?
No, I'm good.
Yeah, all good so far.
Okay.
No, ma'am.
So remember that on Moodle, you'll have notes, which is a little more detailed, but pretty much what we went through tonight. It's a little bit more detailed with the notes that they have on theirs. And then you also have the PowerPoint, which can give extra examples. If you do the reading in the chapters, there's questions that you can have. Does anybody use the questions in the reading? Have you all done that? So that you can do like an assessment to see how you understand. There's also videos to help figure out how to work through those problems that are on there. So don't forget about all of that. And then the practice too is there for you for the whole semester, so that when you go back to do the final exam, you'll still have those. And then this homework is the one that needs to be submitted. Okay. So we're gonna do, oops, I don't want to do that. Number 3. Okay. All right, so we have a chart and it's telling us that we have January 1, we have beginning inventory. It's telling us how many units, what's the cost per unit. Can y'all see it? What the total cost is once you calculate that out. When we sold, tells us what your sales are, how many units you sold, what did you sell them for? Now, when we're calculating out the cost, do we need to know how much we sold it for? Huh? You think? Yes or no? Yes? So when we're calculating the cost, we don't have to know the sales, right? We only need to know the sales when we're calculating the revenue. So if you have a problem that's asking for what was the revenue on that, then you would just take your units and multiply it by what it was sold for to calculate that. But when we calculate the cost, you only need to know these numbers right here. What did I pay for it? Okay, so the company uses periodic inventory. So what's periodic inventory? We just talked about that. At the end of the period of time. Okay. All right, so this is in the way and I don't know how to, there we go. Maybe that helps. All right, so we have the company uses periodic inventory method. We're going to do specific identification. That's telling us what the units are. It says the ending inventory consisted of 290 units, where 240 were from January 30th purchase, 5 are from January 20th purchase, and 45 are from the beginning inventory. So you see they're telling us what's left and where we purchased it, so you can calculate those costs. I might need a paper and pen. Okay, determine the cost assigned to ending inventory and to cost of goods sold using specific identification, weighted average, FIFO, and LIFO. So we're going to do all 4. All right, so the first one is specific ID. So they're telling us what we have left. So we have to calculate what we have left. And I think maybe they'll show me down here. Did I lose y'all?
Yeah, for a minute.
Yeah, you're back.
Okay, did y'all see that I went to number 3 on homework?
Yes.
Yes.
Okay,
Yes.
okay. Can y'all see the page now?
Yeah.
Okay. So it's telling us what we had left. Right here says, can't see it again because this is in the way. 290 units total. And then it breaks it out, 240 from the January 30th purchase. Well, what was January 30th purchase? $8. So you can calculate that out to see, here's what I have left. If I have that left, it's still on my shelf. That's my ending inventory. And are they looking for ending inventory or are they looking for cost of goods sold? Let's see how they're breaking it out. So on here, they're going beginning inventory. So beginning inventory had 170 at $9.50 calculated out. We listed our purchases, January 20th, January 30th, the number of units, the cost, calculating it out. So for my cost of goods sold, It didn't tell me what was sold, right? It told me my ending. So I can calculate that out by just looking to see what they gave me. They're telling me I have 45 from the beginning inventory. Well, 45 from the beginning inventory is 950. So I'm doing this last one first because they're giving me my ending inventory. So I have 45, $9.50. They're also telling me that I had 240, it looks like from the January 30th purchase. So here's my 240 down here at the bottom, showing $8 because that's what I paid for it. They're telling me that I have 5 units from January 20th, and there's my 5 units from January 20th, which was $850. So I'm calculating it out, and here's the dollar amount of my ending inventory, and here's my quantity, 290, which matches what I had left. Okay, so how do I get what was sold? The difference from what I started with and what I have left is what I sold, the difference. So I'll just take the 170 and deduct the 45 units out. 125 at 950, there's my cost. 115 times the 850, there's my cost. And so now I have my cost of goods sold, and I have the quantity that I sold. I sold 240 units total. So if we go back up here to the chart, it's got all the units here, and it's got how many you sold here, 240. So the difference between the 530 and the 240 is what I have left. That's the 290. Okay, so you understand how the chart's set up, how to calculate that number out. Specifics pretty easy because they tell you what's left. Let's start there and then back into what was what the cost of goods is for those units. All right, so let's look at weighted average. All right, so we're doing periodic, so we don't have to know all the ins and outs. We just need to know in the end. So we're going to start with what's available. We have beginning inventory plus our purchases. So we list them out. This is what I have available as my total. I know that I sold 240 units. So I have to calculate out this average in order to figure out what is the average to calculate it. And so let me see if it lists it for you here. Okay, so I have a total cost of $455. So you see that number here. They're just pulling it from here. Divided by the number of units that were available, 530 units were available. So I'm taking the 45.55 divided by 530 to come up with my average of 859. That average is what I'm going to use to calculate my cost. So now I take it and I average it against how many I sold. So it's 240 times the 859 to get my cost. And then what's left, 290 times that same cost. Easy enough, right? Seem hard? Confusing? You're a little confused? You want to go over it one more time?
Yeah, like you almost had me and then you said something else.
And I was like, well, I lost it. Okay, so we're going to list out everything that we have in beginning plus purchases to get our available. What do we have available? Anytime you're doing the periodic, you want to do it this way. Okay, so I have the 530 units and I want to know what my total cost is. And the reason why is because I have to find the average. So I take the cost divided by the units to come up with my average. Then all I have to do is say, well, how many were sold? 240 were sold. I multiply it by the average to get my cost. How many do I have left? I have 290 units left and I multiply it by the average and that's my cost. So I have my cost of goods sold here using that same average that I'm using to calculate my ending inventory. Okay, so I don't have to do it, I'm doing periodic, so I know that I'm looking at the end. So you want to make sure you set it up this way so you're not going through and trying to figure out an average for each one. That would be perpetual.
We're gonna have to know these formulas.
You'll have to know how to calculate, yes. You'll have to know how to do all methods. I can't promise all of them are gonna show up on the test because it would take too long to ask you all the different methods, but you will have to know how to do them for homework. I want you to be exposed to all of it, and then we'll focus in and I'll give you a couple of problems to practice on the review, and then you'll get tested on one or two of those depending on what shows up. Okay, so let's look at first in, first out. First in, first out, which one are we using first? The oldest ones, not the newest, the oldest, the first ones we had. So that beginning inventory is what we're going to be selling first. We use all those, then we move to the next bunch. Then we use all those, we'll move to the next bunch. Okay. So we have the same cost of goods available. We list it out, beginning plus purchases to come up with what's available. So I have my total units and I have my total costs based on the cost is coming from what did I pay for those? So I'm calculating it out this way, okay? So now it tells me I sold 240 units. Well, of the 240 units, I want to go back. What did I have first? I had 170 units. So I got to use those first to sell because I'm going back to my first ones. So I have 170 units at $9.50. So I'll list this out, 170 times 950, calculate my cost out, just multiplying. And then how many do I have left? So I sold 240 and I used 170 from the first batch. Now I have to look at my next batch. So the next batch is 120 units. I only need 70 of them. And the cost is $8.50. So I've used all of these and 70 of these. Do you see why? I went back, I went to the first ones. I used all of them. Now I'm going to the next bunch and I'm going to use what's left that I need to sell. Okay, so we sold 70 out of that 120. So there's the 70 times the 850. I calculated out. So now my cost of goods sold is 2210. It's a little bit different than weighted average was 2062. Specific was 2166. I can barely even see that screen. It's terrible. It's too small. All right, so 2210 is my cost on FIFO. So you see how it changes depending on the method that I'm using. Now I want to calculate what do I have left? So my ending inventory should end with the 290 units. I know I already used all those 170. Those are gone. I have 120 units that I purchased, but I sold 70, so I need to take the difference. And that's what I have left. So I have 50 units left at $8.50 to get $4.25.
Where does it say that you sold 70 on the question?
Okay, so it tells you that you sold 240 units total. And we're going to go back to the first batch that we have, and I'm going to sell all those first. So I just sold 170 units out of the 240 units. So I'm just taking the difference between the 240 and the 170 to come up with how many do I have left that I've sold. It's not telling you that. You have to calculate it out. It's telling you you have 240 units that you sold. You know you used 170 already from the first batch. So now I'm moving to the next batch, and I'm just taking the difference to see what's left out of the 240. So 240 minus 170 was the 70 units. So if I sold 70 of the 120, then I just take the difference again to figure out what's left. So we have 50 units left at $8.50. It's $425. Did that answer your question?
Yes, it did.
Okay, great. Now I have my whole last batch left, right? 240, because I haven't had to sell anything out of those. I didn't sell enough units. So I have the whole 240 at $8, calculated out. Now I have my ending inventory at $23.45. Okay. So I'm looking at the period and I'm saying, how many did I sell for that period? I sold 240 and I start from there. Okay. that make sense? We went back to the first one. All right, now let's do in reverse. Doing last in, first out. So the last thing that I purchased is what I'm gonna sell out first. So I'm listing out what's available. I got my beginning inventory plus my purchases. That gives me my cost of goods available for sale. Then I need to look to see, what did I sell? I sold 240 units. Where did they come from? I'm going to take the cost, 240 units, this last batch here. So I have 240 units at $8. That's my cost, $19.20. So it's lower because you can see that as I purchased, my cost was decreasing. So of course, using this method, the last in is the lowest. It's going to give me the lowest cost, which is going to give me what on my gross profit, high or low, higher or lower. Lower cost gives me higher gross profit because I don't have as much deducting from my revenue. Okay, so here's my inventory and cost of goods sold. That was using all four methods doing periodic. All right, so the second part, the next question, the continuation, and you're going to bring that information and put it into your income statement. I think it should be set up to be the same. It is. Okay, I just wanted to make sure we weren't dealing with new numbers. So we want to compare the income statement for the month of January. Huh? It's a different problem. It's number 4, but it's using the same numbers. All right, so we have sales of 4440. So let's just go and calculate it and make sure. So we have sales. I don't know what I do with my I don't have a calculator. And my phone's probably in my purse. Let me see if it's got it on here for us. Okay, here we go. So we have sales that we sold at $18.50. Let me see if that yes. So it's using the same numbers. So we have 240 units that we sold at $18.50. That's when we need the sales price for the revenue part. So if we want to know what did we sell them for, then I need to know that sales number. I don't have to know what I sold it for in order to calculate my cost in my inventory. I'm only looking at what the costs were. All right, so we have this 4440 is going to be my sales. And then the cost of goods sold, we already calculated. So you're going to have to go and get that from the problem unless you can write it. I don't know how it's going to do it on the homework when you're working through it. So maybe you might want to jot those down so that you have them for the next. So let's go back. So I have my cost of goods sold at 2166. Let's see if that matches. 2165, maybe that's what it is. Well, it says 2166. This says 2165. All right, how do I calculate my gross profit? Revenue minus cost of goods sold gives me my gross profit. So I'm just calculating that by subtracting, getting the difference. It tells me my expenses are 1550 in the problem. That's where those came from. So I key that in, and then it throws in that you have an applicable income tax rate of 40%. So we want to calculate the income before the taxes and then what the taxes are, so we can come up with our net income. So in order to come up with the income before the taxes, we already calculated the gross profit, right? We deducted the cost of goods sold. Now we have to deduct the expenses to come up with the net income, $725. Then we do 40% on that. I don't think it's giving you it's just 40% of the income. Can you calculate that? You have a calculator? Just to make sure, I don't want to tell you something that's wrong. It should take the income of the 725, multiply it by the 40%. 290. And then we deduct that from the income before the taxes, deduct the taxes off, and then we can come up with our net income after the tax. And now we're just going to do the same thing for the other methods. So we know the sales already. We already calculated that out. So it's just going to be the same. Then the cost of goods sold is going to come from your table. So we have 2062. It's saying 2061.60. So for whatever reason, it's using the exact number here. It's saying average to 2 decimal places. So just keep that in mind. If you're having problems, just check and make sure the rounding could be the problem. Because I don't want you to have points taken off of that. Okay, so we have our cost of goods that we plugged in. So we deduct that from our revenue to get the gross profit. Our expenses they gave us $15.50, so we deduct that. So gross profit less the expenses gives me my income. And then I take it and times it by 40%. Deduct that, and then I'm left with my income after the taxes. Same thing for a LIFO. Okay, number 2, which method yields the highest net income? So all you're gonna do is look to see, where do I have the highest net income? Which one has the highest net income? Right here, LIFO. Does net income using weighted average fall above, between, or below FIFO and LIFO? So we're looking at average 497. It should fall between. So we have FIFO at 408 and LIFO at 582. So it falls in between. And then what method would yield the highest? Didn't we just answer that? Which method yields the highest net income? Which method would yield the highest net income?
Is that not the same question?
I know, that's what I'm trying to figure out. Which method would yield the highest income? So, all right, it looks like it's wanting you to think about the rising costs because our cost is lowering. Now, okay, here it is. If costs are rising instead of falling, so we got to flip it. So if the costs are rising instead of falling, which method would yield the highest net income? So we went over that. You can look at the notes and see if you get confused, just read it again, how it works for each method. So it says if costs are rising instead of falling, so they're going up, then FIFO would give us the highest net income. Why is that? Because the older inventory has a lower price, right? So if I'm using that lower price, then I have a lower cost, which means I have a higher net income. That's why it's FIFO, if you have rising costs instead of falling. So that is on here. Right here, this section. So it's just asking to think about it a little bit, trying to understand what's happening with those costs. The cost is lower, that's going out. I'm going to have lower costs, which means I have higher profit. All right. Let's look at the next one. Do you have any questions on periodic? Okay, we have the same setup. Says the company uses perpetual. So now we're going to do same thing. It should have the same tables. It does, but we're going to use perpetual instead of periodic. So what does perpetual mean?
Or frequently?
Right. So each transaction, we're going to figure out, each time we sell something, we need to figure out what was the quantity coming from what batch, using FIFO or LIFO, or what was my average at that time when I sold that many units. So you'll have to calculate it each time. All right, so let's look at specific. Now remember, specific should be the same no matter what method you use, right? Because you know, they're telling you what's left. It's gonna be the same. Do we need to walk through specific again? No? Do y'all understand specific? Y'all want to do it? Let's do it. Okay. All right. So it tells us, that's how I lost everybody last time. Make sure I put it here. The company uses a perpetual inventory system for specific identification. Ending inventory consists of, now it's telling me what I have left in the end. I have 230 units total. 200 are from January 30th. So I'm going to have 200 times the $6. That's going to be my ending inventory. So here's my 200 times my $6, 1,200. I have 5 that are from January 20th purchase. So I'm looking at January 20th. I have 5 left that were at 650. So here's my 5 at 650. Calculate that out. And I have 25 that are from the beginning inventory. So 25 at 750. Calculate it out. So here's my ending inventory. Now I can back into my cost of goods sold. I take the difference. So I had 150 less the 25. I have 125 units at 750. And then I had 80 less the 5 that I had left. So I have 75. And then the last purchase of 200, I sold all of those. So I don't have any left. So here's my cost of goods. All right, so now we're going to look at weighted average. So keep in mind, we have to calculate the average each time we have a sale. So we're starting with 150 units at $7.50. So it's just coming right off the chart. So 150 times 750. We have 1125. Now I have 110 units that I sold. So if you go back to your table, it says on January 10th, I have 110 units that I sold. Do I need to worry about the 1650 right now that I sold it for? Not for cost. We don't worry about that. I just need to know how many units. So if I'm doing average, I need to know what is the average. Well, the only thing I have is the beginning inventory. I don't have any purchases yet, right? So I have to use the same cost, which is 750. And that's because that's the only batch I have. I don't have anything to add to it yet. So when I sell, I'm selling from that batch at 750. Okay, so we understand why it's 750? Because that's all I had. So 110 units times 750 to give me the 825. And I have an inventory balance at that point. It's telling me I sold 110 out of that 150. So if I deduct the 110 from the 150, I'm left with 40 units at $7.50, which is 300. So that's what I have left in my ending inventory. Okay. January 20th, I make a purchase. I purchase up here on my table. I purchase 80 units at $6.50. So I'll put that on my purchase section. So here's my 80 at $6.50. Now I can calculate out what do I have available in order to calculate my average cost at that point. So I have a new average now, right? It's not going to be 750 anymore because I just bought 80 at 650. So now I have to combine them and figure out what do I have available? What did I pay for those? And now I can calculate a new average. So I'm listing out my 40 units that I had left over from my beginning balance at 750. And then I'm listing what I purchased, 80 at 650. So I have a total of 120 units and I have a total of 820 in costs. What's my average? Just divide. So I have $6.83. So the next time I sell, if I haven't bought anything else, that's going to be my average that I use. On our chart, it tells us we sell 90 units. So just calculated out what I had available, what I had left from the beginning, what I just bought, and I calculated to get a new average. So when I sell these 90, I'm not using the 750 or the 650 for the average cost. I'm using my new average. My new average is $6.83. Okay. So here I have 90 times 683 to get the 614.70. That's my cost of goods sold. What do I have left? I had 120 units. I deduct 90. So I'm left with 30 at the average of $6.83. So that's my new calculation of what my ending inventory is. Okay, I have 30 units at 683. On the chart, it says I buy 200 more units at $6. So I add that in. Here's my 200 at 6. So now what do I have available? I have 30 units at 683, and I have 200 at $6. I have a new average, $6.11. So the next time I sell, what am I using? Not the 683, not the $6. I'm using $6.11. That's my average. Okay, so that's what I'm left with. I didn't have any more sales after I bought that. So I calculate, what do I have available? 30 that I had left at $6.83 and the new purchase of 200. Calculate your new average. That is going to be your ending inventory. Do you have any questions on that?
To get the average, you're dividing the inventory into units.
Yeah, so you take in the cost. You want to make sure to use this total of what you have available. So when you're calculating out the groups, you want to take, all right, so let's go back up here. So we had 150 units, we sold 110, so we had 40 left over, right? Then I buy 80. So when I'm calculating out what the cost is total for my ending inventory, I want to make sure that I'm using how many units do I have left times what was that price? What was that, either that average or what was that batch coming in for the beginning? That's what I have. Then what did I buy? I bought 80 at 650. So now I can add them together. I can add the units together and I can add the total cost together. Then I calculate my average. Okay, so I have 120 and I have 820. So I just take the 820 and divide by the 120 to get your 683. I don't know if it gives you, it doesn't give me any calculations. Okay, so when I come into the next grouping, I'm not going back to any of the 750. I'm not going back to what I purchased at 650. I'm not going back to those numbers. Now I just have 30 units left at 683. That becomes my new, what I have available until I purchase again. So now I purchased the 200. So the 200 times the 6 is 1200. Now I can add those two groupings together and I get a new average. So you want to make sure you add them together and then average. Okay. And not all the units together. You don't want to take how many units do I have an ending total 230 and then I'm calculating it by all these different individual lines. You've already got a new average, so you have to use that new average for your next purchase. Don't try to combine them. Okay, we're going to look at first in, first out. We're starting with 150 units at 750. We're selling 110. Well, what do I have to pull from? Just that one batch, right? So I'm going to pull out of that. So I'm using my 750 cost. I have 40 remaining. Now I can take my 40 at 750 and I have 80 units at 650. So this is what I have available. I have two different batches available to choose from when I make my next sale. My next sale, I'm selling the 90, right? 90 units. Okay, so on January 25th, when I sell those 90 units, I'm using FIFO. So which ones am I selling? This is what I have right here available at this particular moment in time on January 25th. I have 40 left at 750. I have to use those first because it's first in, first out. So I'm selling these 40, and then whatever is remaining out of the 90 minus 40 is 50. So I'm taking 50 from the next batch, which is 650. Well, I sold all those, so these are gone. And I sold 50 of those. So now I'm left with 30 at 650. That's what I have left in my inventory. I have 30 units from that batch that I just purchased on the 20th. Now I buy 200 units. So I have 30 at 650 and I have 200 at 6. Let's say I sell 50 units. Which ones am I using out of this grouping? Which one would I use first?
30 of the older ones,
30 of the older ones.
and then
How many do you have left? Yeah, so if we sold 50, we would have 20 left. I would take that 20 out of the 200. Okay, so my ending inventory, this is what I have left. I have 30 units and I have at 650 and I have 200 at the $6. So you see how we sold those first units? So this is walking through how to do it. But remember with FIFO, you can use either method. Okay, let's look at LIFO. Okay, so we're doing the same thing. We have 150 units at 750, 110, we only have one batch, so we're pulling from that batch. We have 40 left over at 750. We buy 80 units at 650. Now I have 40 at 750 and 80 at 650. I'm using LIFO. So when I sell the 90 units, I want to take the 80 out of here, right? So there's my 80 units at 650. I'm going to sell all them first because it's last in, first out. So I'm taking all the 80 and then the remaining, which is 10 from the older batch. So here's that grouping, and I'll have 30 of those left at 225. And 10 I sold at 750. So now here's my cost of goods for that sale. And then I buy 200 units at $6 and I add them in. So I have 30 at 750 and I have 200 at 6. So just keep in mind how this is laid out, because when you're doing your homework, you may want to say like, okay, 80, put my 80 first. I don't know if it's going to say yes or no, if it's going to like that. I don't know how finicky it is. It might say it wants the 10 to stay that first batch on that top line. I'm not sure if it'll let you do the 80 first and then the 10. So just keep that in mind. Okay, so we understand how we calculated the cost of goods and the inventory perpetual method. So you see the difference, right? We're not just looking to see how much did I sell for that whole time. I had multiple sales. This is how many units it was. And then I'm kind of just using my numbers from there. This is looking at what did I have available when I made the sale each time, not in the end. Okay, and then same thing, this is the income statement. So we want to calculate out the sales, bring in the numbers we just calculated, and we also want to figure out what the tax is. So our sales, it's saying that we had 200 units that we sold at 1650. So we just multiply that to come up with a number. So you have 3,300. What was my cost of goods sold for specific? $14.25. So my gross profit, I'm taking the difference, sales less cost of goods sold gives me gross profit. Less expenses, they tell me what the expenses are, 1350. So now I have my income before the tax. And that's what I want to calculate the tax on, the 525, multiply it by the 40% to come up with my tax expense, which is $210. Subtract that from the 525 and I come up with my net income after taxes. Okay, same thing on this, on these other three. Revenue is the same. Pull the cost from what you just calculated and then just do the math. So do y'all have any questions on that? Okay, so which method yields the highest net income? Well, we can look and see because we just calculated out LIFO. Does net income using weighted average fall between FIFO and LIFO? So here's my weighted average at 306 and it does fall between. And then which method, okay, so we're using rising instead of falling. What method would yield the highest net income? FIFO. Because remember, it's rising, so the older ones are less in cost. So my cost of goods sold is less, which means my net income is higher. Number 7. Okay, so it's given us our ending inventory. This is what we have in inventory. We want to compute the lower of cost or market for the ending inventory. So remember, we have to do the calculations to see which one we're going to use. So we're going to take 39 units, times it by the 61 to get your cost. And then the market is 57 times the 39 to get the market value. The lower cost of market applied to the items. So which one's lower here? The market, right? So we're going to use the market price. The bats, again, just calculate it out. I have 32 units, multiply it by your cost of 79. So we have 25.28. We have 32 times 85, so that's 27.20. Which one's lower? My actual cost or the market? Cost. So that's what we're going to keep. We're going to keep the cost. So remember, if the market's higher, we're just going to keep what we have. We're not going to adjust it. Do the calculation for the shoes. And the actual cost is $51.94. Market is $54.06. So we just keep our cost. Do the calculations for uniforms. And it comes up the same. So we're using the actual. And then you add them up. That's it. Bet you wish you had a bunch of homework like that. Okay. So we have perpetual inventory system. We have our activities here. It's got a beginning inventory. When we purchase, when we sold, we have 2 purchases and then we sold. So this is basically doing the same thing, but I think it's laid out a little bit different. Okay, so it's saying compute cost of goods sold, cost of goods available for sale and the number of units available for sale. So they want to know what's available as far as total cost and what is the quantity. How many units do we have available? All right. Well, we had 570 to begin with, and then we're just going to add in our units. So we purchased 380, 190, 200, 590. We add them all together. That's what's available. So we put our units down here, 1930. How much did we pay for them? Well, you're going to have to calculate that out. So you'll have to multiply the 570 times the 50. Let me see if it does it down here. Yeah, here it goes. Okay, so we have 570 times the 50 to get the cost. 380 times 47, 190 times 35, 200 times 55, and 590 times 53. So once I calculate that out, now I can add them all together to come up with the 95,280. So we see how we figured out what was available, right? We have beginning balance plus purchases gives me what's available. So this is how many units I have, and that's the total cost of those units. So if I'm looking at a balance sheet, I'll see inventory, 95,280. Right? If that's how many units I had, that would be what would show up on my balance sheet. Compute the number of units in ending inventory. Okay. What method am I using? I guess it doesn't matter yet. Okay. So if I had 1,930 units available, they're giving me my sales of 770 and 790. So I have a total of 1,490 units that I sold. The difference is what I have left in units. So just take the 1,930 minus 1,490, and that should give you the 440. Now we're going to compute the cost using the different methods. So keep in mind, we're using perpetual, which means we have to calculate it as we go. All right, so they're just looking for an answer here. You're going to have to do the calculations. All right, let's see if we can do them. Right on here. I think it lets me write. It's a little bit funky, but let me just see. Maybe it's got the. Oh, it's got it right here. Okay, so we're doing the FIFO perpetual. So we have our beginning balance, 570 units at 50, which is 28.5. Then it says we have 380 units that we purchased for $47, and then we purchase again 190 at 35. So we're taking our purchase of 380 times 47, the 190 at 35, and we're putting all of our units here that we have available to come up with the cost. So it'll be the 28.5 plus the 17,860 plus the 6650. So do you see this grouping? I don't know if I can. I don't see, wait, maybe right here. Okay, this little grouping right here. So all that is the beginning inventory and then my purchases. So all three of those batches are right here to come up with that cost. All right, so now I sell 700 units. We're doing first in, first out. What has to go first? These first units, right? The oldest stuff. So the 570, those have to go out first. The remaining, whatever number that is, 700 minus the 570 is going to come from this batch here, the $47 batch. All right, so let's go back and look. I wonder if I can erase. I don't know if I'm able to get it back in there. Okay. So here's my sale on 3/15. I have the 570 at 50. The remaining is 130 at 47. And there's my cost of goods sold. What do I have left? Well, I got rid of that whole 570 batch, right? We sold all those. I have 380 less the 130, which is 190 at 35. Is that right? Did I sell all of these too? That doesn't seem right. Does that seem right? Oh, over here, I'm sorry. I had 380 that I purchased at 47. So the difference between the 380 and the 130 is 190 at $35. So I have 190 at 35. I have whatever the difference is, 250 at 47. And I no longer have the 570 because I sold them all. So it's this, I was getting confused looking at it, but let me, where's the button to write? Maybe that one. Okay, so here's my sale. And I have 570's gone. I have the whole 190. Nope. So let me. The whole 190 at $35 I still have. And then I have the difference between the 380 and the 130, which is the 250 at 47. So this is what I have left. And the cost is 18.4. Now I purchase again. So I have 200 units at $55. So I'm going to add them in the mix. So I have 250 at 47, 190 at 35, and I'm adding the 200 at 55. So when I make a sale, this would be the group that I would pull from, right? That's what I have left. So we have another purchase on September 5th for 590. So we're going to add those, and then we'll have our sale at 790. Won't let me. Okay, so here's my purchase on 9/5 at the $53. So now I'm adding that to the mix. So I went from this available to this available because I just added the 590. Okay, so when I have the sale now of the 790 units, I think it was total, 790. I have to look and see what do I have first. Go to the oldest, the 250. So the 250 is going to get sold. The 190 is going to get sold. The 200 is going to get sold. I add those three up, subtract the 790, and whatever the difference is what I'm going to use out of that last batch of 590 at 53. Okay. So I have, this is what I have left, 440 out of my 590 batch because I just sold 150 of them. So this is my ending inventory. And this right here is my cost of goods sold for that sale. This is my cost of goods sold for this sale. You add them together, you get your total cost of goods, and then you have your ending inventory. Okay, so let's go back up. So it says, what was the ending inventory for FIFO? Well, we just figured that out. It's right here, that 2320. And you key it in. So you have to know how to work through it. We did those tables first to do those homeworks and know how to work through it, and then you can do this one. Okay. Now let's calculate out LIFO. I don't know why this doesn't always work great. All right, so let's look at LIFO. So we're going to do same thing, just in a reverse. We're going to use the last first. So we have a beginning inventory of 570. We purchased 380 and we purchased 190. So now our batch is 570, 380, and 570 right here. When I sell, let's see, the first batch I think was 700 units. Okay, so we have 700 units that we sold on 315. I'm gonna use what first? Last in, first out. So what batch? The last one we purchased. The last one we purchased was this 190 at $35. So that one's gonna go first. Then I have 380 units at 47. And then I gotta look to see what do I have left to get to 700. So add the 190 to 380 together, see where you're at. Deduct from 700, I need 130 units, and I'm gonna take that from the beginning. So I'm working backwards. What do I have left? I should have 570 less the 130, which is the 440. That would be my ending inventory at that point right here, this 440. Okay, then I purchase again 200 and I purchase 590. So I have 440 units at 50, 200 at 55, and then I have the 590 at 53. I sell 700. Again, which pot we pulling from first? The last purchase, which was at 590 units. So I'm going to take the 590 times 53. I sold 790, so I need 200 more. Well, that's how many I had in the batch before it. So I'm going to take all 200 of those, and that's going to be my cost. And what do I have left over? I have the 440 at $50. So now my ending inventory for LIFO is the 22,000. Do y'all get this when you submit the solutions? Do y'all get that? To help you if you don't know how to calculate it out. Okay, so weighted average. Right here. So we have to get the average as we go. So we have a beginning inventory. We purchased 380 and 190. We have to calculate all that out to figure out what is our average cost. So we're averaging out the beginning inventory with the purchases to come up with an average. So when we calculate the average cost, once we purchase that 380 and the 190, my average cost is $46.50. So you see that right here? All we're doing is saying, okay, this was my batch that I bought. I'm adding that to the beginning. So it's the 28.5 plus the 17.8 plus the 6,600. I'm adding all those together, divide by the number of units I have to get that $46.50. When I sell, that's the average I use because that's what I had available when I had that sale. So I'm selling 700 units at $46.50. So I deduct 700 from my total batch. Now I add to it 200 and 590. So I had 440 left over at that average of $46.50. So I got to calculate that out to see what it was. Then I have to add in my new ones. So I have 200. I'm going to come down here. I'm not going to do this one because they're not looking for that. 200 at 55, 590 at 53. So now I have that in my mix. So here's my 440 at $46.50 plus the two new purchases, the two new batches. I add all the quantity up here and I add up all of the costs to come up with my total cost for those units. So that's what's available the next time I have a sale. So I want to take the total divided by the units to come up with my average, which is 51. So here's my new average. Next time I sell, that's what I'm using, the 51. And it's right here, 790 times 51 to get the 40,000. So then I add, hopefully I don't lose everybody. Okay. So now my ending inventory has that new average and it won't change until I have another purchase. Does that make sense? Bet you y'all won't look at merchandise in the store the same. Think about those people who are doing all this inventory. The good thing is that the computer systems calculate it for you now. You're not sitting there trying to do all that, right? The system's calculating out your averages or using those units that you had in there at the time of the sale. You know, you're not sitting there doing all that. Okay, specific. They're telling us what we have left. So the 280, let's see, wait. Units consist of 570 from the beginning inventory, 280 from the February 10th, 190 from the March 13th, 150 from the 21st, and 300 from September 5th. So it's telling us what the units sold consisted of. So you would just multiply that out to come up with it. All right, so here's my cost available. So all I'm doing is saying, okay, here's all my units that I had available. And then I'm gonna say, what did I sell? It just told me how many units from each batch I sold. So here's the calculation right here. So the 570, 280, 190, 150, and 300. It's telling you what batches you had that you sold. So you can calculate that out and then deduct it and you get your ending inventory. Does that make sense? So right here it says units sold consist of 570 from beginning, 280, and they're just going and grabbing the cost from those batches. Okay. Compute the gross profit earned by the company for each of the 4 costing methods. So now we're going to just calculate the sales by taking the number of units that we sold times the sales price. So 700 times 75, 790 times 75, so the whole 1400 times 75. Come up with 111,750. It's the same all the way across. And then you just go grab your cost of goods that you just calculated and you plug those numbers in. So the gross profit is the difference between the sales and the cost of goods sold. Do you have any questions? Okay. So we have an inventory that's destroyed by a fire on September 5th. So they've given us data for the current year and they're available for the accounting records. So we have our beginning inventory was 250,000. January through September 5th, we purchased 344,000. January 1 through September 5th, we had sales of 688,000. So the current year estimated gross profit rate is 38%. So we have beginning inventory 250, they gave us that. Net cost of goods purchased, just bring it down here, 344,000. Cost of goods that were available. How do we get available? We have our beginning plus our purchases. So we're just going to add those together. Come up with the 590, what's available. And it says estimated cost of goods sold. So you have to calculate that out, and it's 30, you're using that 38% to calculate that out. So you have your 688,000 times 1 minus the 38% to come up with that cost. Okay, so they take in the 688,000, which was the sales, and then you multiply it by 1 minus the 38%. That way you can calculate what was the cost, estimated cost. So cost of available, cost of goods available, less cost of goods sold gives you your inventory that was destroyed, estimated, and what you had left. Okay. So if we have that happen, we have to write those costs off. Sometimes you get insurance money and it'll wash out some of that loss, but on occasion the deductible might be higher than you lost. So you have, you know, you have a cost of of damages, and usually that's shown in a different section on the financial statements. You'll have a loss of damages due to however you want to word it. You can just put loss from damages, or you can be a little more specific. So we recently had the hurricane. Well, a lot of our buildings had a lot of damage greater than the deductible. So we have an account set up for that. And we have some apartments, and not only did they have damage from the storm, but they also had a fire after that. So now we have two separate accounts that we're keeping track of that on the financial statements. So we can see the lost damages from the hurricane, lost damages from the fire. So it show up in a little bit different section. Okay, do y'all have any questions about chapter 5?
No, ma'am.